Manish Gunwani is with us, Head of Equity, Bandhan AMC. Manish, good morning. Great to have you with us here. Thank you very much for joining us. 60 points and a little bit of a rebound and some breathing space, I guess, right, after those comments and the U-turn yesterday. It's been pretty bad to start to 2026, Manish. How are you thinking about markets?
Yeah, Prashant, I think we are in a bit of a very peculiar macro situation right now. The thing is, Indians are buying stocks and gold, which are, in a sense, both imported, which is putting a lot of pressure on balance of payments, which is in turn putting pressure on currency. And that pressure on currency is discouraging foreigners to come partially into the stock market. So I think this loop needs to break. It could break by dollar weakening globally. It could weak by a bit of rupee depreciation. But yes, tactically, it does look like we are caught in this loop at this point of time. It's peculiar because actually gold going up improves the balance sheet of India. I mean, we are the biggest owners of gold and silver. So structurally, it should be very positive for India that gold prices go up. But at this point, definitely there is some pressure on the currency, I think, which is discouraging foreigners from buying Indian equities.
Manish, other than the currency issue, which is plaguing foreigner interest in India, is it just the sentiment towards India that is hit? Or do you think fundamentally also, other than the currency issue, there are factors which are keeping investors at bay and keeping our returns in check?
No, there are. One is, of course, we don't have any big AI play. And China, Korea, Taiwan, which are the big weights in emerging market index, they have very big companies in AI. Second is this US-India agreement thing, which increases risk premium for India. It's not a very big impact on the economy, but it definitely increases the risk premium, especially in the perception of foreigners. So yes, there are obviously factors beyond the currency. Earning growth is steady, but nothing exceptional. The point is, last 5 years, Nifty 50 earnings have outperformed nominal GDP. So you can't take a 2-3 year view that earnings will be anything spectacular. So there are a lot of things, but the good part is, as I said, that the macro stability at current account level, the inflation level, the household balance sheet, especially with this rise in government, there are positives as well. So we just need to, I think, wait out the storm of this balance of payments being negative. It is actually also transmitting to monetary policy that while we cut rates, the volumes, etc., are not really coming back.
All right. Hi, Manish. Good morning and good to see you in. Manish, I recall last year, you were talking about maybe the small cap index is a good place to be into.
Yeah.
And maybe, in fact, the hope is that the small and the mid caps do better in 2026 because that's what makes portfolios feel good. So when you're allocating fresh money, do you think that, these broader markets are actually providing an opportunity, or do you believe they still have more pain from here on?
Yeah, I mean, we definitely think small cap space is very interesting. And obviously, as prices have corrected both in time and price, let's say versus 1 year back, we're more positive on small cap today. We continue to believe that on a 3-5 year basis, that is the asset class which will outperform because, as I said, for large cap, the issue is if earnings have already outperformed nominal GDP for last 5 years, then the best hope is they will mimic nominal GDP of, let's say, 10-11% over the next 3-5 years. Whereas in small cap, because it's such a wide universe, there's a lot of technology change, there's a lot of geopolitical change, there are different themes you can play. So we do believe that a lot of small caps are incrementally getting into very attractive zone. But as I said, tactically, you need to see a bit of currency stability. We all know that when liquidity gets tight, small caps will not work. And we are in that situation at this point of time, where if your balance of payments is negative, obviously liquidity will not be great. So we just need to time our exposure Uh, but beyond a point, you can't predict macro. So we keep buying gradually. We are reducing cash levels in our fund, which were relatively high, let's say 3 or 6 months back. So incrementally, definitely, I think exposure to small cap should go up.
Okay, and what's the current cash levels, Manish? Since you said that you have reduced it relatively, what was it 6 months ago, and currently what are the cash levels?
So this is fact sheet data of the small cap fund. We used to have 14-15% cash level. It is reasonably below that right now.
You're saying, Manish, that you would allocate more towards mid and small caps now. Yes. That's what you're saying, Manish, incrementally.
Yes.
Okay. Many of your colleagues across the industry are doing the opposite, Manish. They're increasing exposure to large caps. I mean, is that... Yeah, sorry, go on.
Look, it's not so much a tactical call. As I said, there are macro challenges for India. But the point is, if I take the universe that is available in small cap, I think the large and mid cap spaces are very restricted. And as I said, their earnings growth tends to mimic nominal GDP growth, which will not be anything great.
No, let me clarify, Manish. Bulk of what I described, right? And the caveat is, I mean, what you do also what depends on what you've already done in that sense, right? So if somebody has a lot of exposure, then you trim and then go large cap. But the motivation from what I kind of picked up is not so much about capital appreciation, it's capital preservation. Protect NAVs. I mean, that kind of thing. By going into large... I mean, that's the underlying thread I could pick up. Go on, sorry.
I think clearly over the last 15 months, we have seen, as I said, time price correction. Rupee has depreciated. So in dollar terms, we are probably for last 15 months the worst performing market globally. And I agree, next 3 to 6 months, maybe we might get a bit more correction. But I think... and we keep saying that the small cap space, you need to see on a 3 to 5 year basis. And bottom up, I think incrementally you are seeing stocks which can potentially double in the next 3 to 5 years in the small cap space. And that's usually a good return to have. So yeah, timing based on macro is one thing. But macro can change very fast. For example, if the Fed governor comes and cuts 50 bps, then all these liquidity issues will get sorted. So we can't really time macro beyond a point.
Yeah, no, we can't. Absolutely, Manish. Would you want to identify? I mean, just for talk about maybe a situation, a stock where you think, it's becoming obviously very, very attractive. Just and like at a throwaway valuation, just as an example, Manish.
Yeah, so a lot of the global cyclicals, because they've not been the focus of the market, whether it's metals or shipping. I think the global economy is doing very well. Everyone thought US will go into a recession. That's not happening. China's kind of gone through a massive property deflation coming out of that. And I think the global cyclicals like commodities and shipping, they are cheap versus what assumptions that are being factored into earning estimates. So I think that, for example, is a space that looks where heads you win, tails you don't lose kind of situation. I think very cheap lenders, price to book 1 or below, that continues to remain an attractive space as well. Because in India, as I said, household balances is pretty okay, growth is pretty okay. So we don't expect any big asset quality issues in lending. I think small tech platforms also are interesting. So there are a host of things that look interesting.
All right, Manish, one sector that you all were bullish on, which you briefly mentioned, was the metal space. And I think the second half of last year were quite bullish. Last quarter as well, you reiterated that stance. From here on, how do you approach it? And how would you play it? Metals have seen a melt up. Gold as well is doing well. You also mentioned about financiers. Would you go the gold financiers route? Do you think the industrial metals have more to go from here on? And within that, what would it be? ferrous and non-ferrous. Give us some color with regard to that metals play.
Okay, the drivers are different, but I think all are interesting spaces. I think gold finances are a bit expensive right now because I think all lenders can do gold finance if it's attractive, so beyond a point. But I think precious metals, obviously, a trade on global liquidity. And I continue to believe that the debasement of paper currencies will keep happening. I think industrial metals also look interesting. I think non-ferrous is different from ferrous. I think non-ferrous is more about China and Europe doing fiscal stimulus, coming back. US continues to remain resilient. With protectionism, every country is doing capex, whether it's defense or semiconductors. The demand seems okay. Industrial metal stocks have run up, but maybe there's still some ways to go. I think the ferrous space is a bit dependent on this anti-revolution thing with China and also the Chinese currency, right? I mean, I think some part of your portfolio has to be positioned for extended dollar decline versus yuan, because both the hard numbers of current account and all, and the narrative about China now seeming to come out of this trade war pretty strongly. You could see yuan at 7, from 7 going to 6 or 5 over a period of time. Some part of a portfolio, which is probably steel, is the best on that. So I think the ferrous is a bit more dependent on what China wants to do in terms of capacity rationalization or how they want to handle the currency. The non-ferrous part is, I think, a bit more clear.
Absolutely. Interesting views there, Manish. It's always good to get that perspective and interesting conversation. We'll follow up on some of this in our next one. Thank you very much for joining us this morning here on CNBC TV 18.